Okay, we want to diversify our portfolio a little bit, and when we do that, I mean, we can do strictly ETF, and index options and so forth to build our portfolios. But sometimes it really does pay to have a stock or two in the portfolio because, not all stocks move exactly the same as the market. Some stocks are going to go up when the market's going down, and some stocks are going to go down when the market's going up. And that really helps diversify the price risk that you have in your portfolio. So, you want to take a look at stocks that have good and liquid options in them. IBM is one of those stocks. You also want stocks that have a good chart. And a good chart, by what I mean a good chart, is that it looks like it's either trending or it looks like it's channeling in some way. And let's take a look at IBM here just for a minute. If you go to your profit charts and click on profit and then type in IBM and click enter, you'll see a chart of IBM here. Let's do a real quick little, let's take a quick look at that and draw a little channel around it and see where the price has been and where we think it's going. If we draw a quick channel line on this, it looks like IBM right now is up around 126. And it looks like it's had a pretty good run. It's run up from about 96 maybe back in the beginning of January all the way up to 127. And for IBM, that's a pretty good move. And so they've been, it's been moving inside of this little channel going up all the way up to, I think the high here looks like it's around 129 maybe. If I just put my cursor over there, I can see it's 128.68. So let's say we wanted to do something with IBM because IBM looks like it's kind of topping out here, and we may get some sideways action, or it might move down a little bit. Who knows? But it looks like it would be a good candidate for us. So let's go to our Trade tab in our Thinkorswim platform. Go over to Trade tab. We'll pull up IBM and pull up the June options. Now there's one thing that we want to look at before we really start to take a look at these options, and that is close up, you want to close up your option months. So the arrow for June of 08 should be pointing towards the June and not down, so you don't have the options open. And the same with July. And now, and for all the months. So what we want to do is we want to go over to the right side and take a look at what's called the implied volatility of these options. If we follow June all the way across, we can see that the implied volatility is 21.1. July it's 23.4. October it's 25.6. And if we were going to do a calendar spread on any one of these, what we want ideally is something called a positive skew. A positive skew means that the front month, which would be June in this case, has a higher implied volatility than the second month that we're going to be buying. The reason for that is that volatility increases the price of the option. So we want to sell the option for as much as we can possibly get. And if the implied volatility is higher in the front month, that means the options are actually more expensive than the ones in the second month, and those are the ones we're selling. So that actually works in our favor because we want to sell them for as much as we possibly can. So if we take a look at June, we see that it's 21.1% implied volatility. The July is 23.4. If we subtract those two from each other, we have a negative number. We have a negative 2.3 approximately. So that's a negative skew. We don't like negative skews normally over 2 points. So we're not going to do IBM at this point. What we'd like to have ideally is an option in the front month that has a higher implied volatility than the one in the second month. So let's take a look at another stock. In this case, let's pull up MNST. Okay, MNST is Monster Worldwide. They run a website for people who are looking for a job. And in this case, you can see that the June options, the front month options, We're still in our trade tab here. We want to take a look at MNST is the option symbol. And if we follow June across, we see that it has an implied volatility of 51.2. 51.22 to be exact. The July options have an implied volatility of 47.53. Now remember that the front month, if it has a higher implied volatility than the second month that we'd be selling, is called a positive skew. You take the front month of June is 51.2 and you subtract it from the 47.5 and you get a number. In this case, it'll probably be, looks like it's going to be about 370, 3.7% positive skew. Now, generally when that happens, when you have something more than 2 points over a positive skew, so that in this case it's 3.7 positive skew, it means that the probability is that they have earnings coming out very shortly. And that's why the options have such a positive skew on them. If that's the case, then what we need to do is take a look at our profit charts here, and let's put in MNST, and let's take a look at the chart here. The chart, as you can see, I've been following it for a while. It's been channeling down into this back, oh boy, if you go back about a year or so, the high was 49. It's currently selling for 27.09. We've had a little bit of a run up here in the stock lately, but it has been trending downward. These actually can be very, very good stocks to put calendars on, because not only has volatility increased as the stock has moved down in price, but also they don't tend to bounce back right away. They tend to channel and they tend to move in a range for a while before they actually start breaking out to the upside, if they do continue to the upside. So this may be a very good candidate for us. It looks like they just had earnings. You can tell on the profit chart. If you have it set up, I think you can go into chart settings, go into your preferences here, and there's a couple of different things that you can actually put in here. Let's see. Now that would be for appearances. Let's take a look at the other here. Themes, watch lists. Now it looks like they include those automatically, so you shouldn't have to. Yep, they do. It looks like they include those symbols automatically, which is a good thing, because you want to know when a conference call or when an earnings announcement has been made. And it looks like they just had their earnings announcement. So this is a very good candidate then for a calendar spread. Let's go back to our trade tab then and take a look at the June options. Now we've got calls and puts, and we'd like to do double calendars. Those are my favorite. You can also do single calendars, and then later, if you need to adjust, go into a double calendar. But let's do a double calendar on Monster. And we generally take the strike price that is just above the current price. So the current price is $27.14. So we'll take a look at doing a double calendar on the 30 calls. And then we want to do a put calendar as part of our double calendar at the 25 calls. So let's just right click and go to buy double diagonal, and then select double calendar in the menu. Now we have to change the puts on this. It automatically brought up our 30 calls that we want to do, but we have to change the puts to the 25. Alright, let's just do one contract for now. Looks like we're going to have a debit of 85 cents on this calendar. And let's go over to the Analyze tab and see what this is going to look like. Let's go to right click on the green boxes where you just in your trade tab and bring up Analyze Duplicate Trade. You just do that by right clicking, click on Analyze Duplicate Trade, and then go right into your Analyze tab. Make sure you have single symbol selected down here under Positions and Simulated Trades. And let's see what this looks like. It's not a bad looking graph. It could be a little bit tighter maybe. The problem with Monster is that even though the stock price is only $27, we don't have any other options besides a $5 wide strike in between these. Let's take a look at July. Yeah, it's about the same for July. So what we might want to do in this case is simply do a single calendar. Let's take a look at just doing a, let's go back to our Analyze tab here for a second and delete that. Because I don't, and basically I didn't like that picture. The picture didn't look good to me. So what we're going to do is we're going to go over here and just buy a single calendar on the June 30 calls. And we'll leave it at one contract for now. Then we'll do the same thing. We'll right click in the green area and go to Analyze Duplicate Trade. And as you can see, we like to be in the center of these trades, but this one is slightly off, isn't it? The actual price is down here to the left. So let's go to the 25. Let's go right at the money. And that one is a little bit too far to the right. So we may not have a good calendar here either, and we want this price really to be right at the center. And we're just not getting it. So this may not be a good candidate for us. However, what we can do is take a look at doing both a call and a put at the same strike price. And in this case, we've got the 25s there, and we can take the 25 and do a calendar on the put side as well. And let's take a look at that. Well, that doesn't help us at all. Even if we went down to 22.5, we're still way outside. We really ideally want to be in the center of this tent, not over to the right. So we're going to eliminate Monster from our potential candidate list. It was looking very, very good here. However, we're not getting the type of profit graph that we really need to make this a profitable trade. Let's go to another stock. Let's go to Autodesk. I'm sorry. It's ADSK. ADSK. Let's take a look at this. First, we're going to check the implied volatilities. And we've got 32.9 on the front month and the 34.9 on the second month. That's a negative skew of 2%. Now 2% is not too bad. If we do 2% or under, that's okay. So this may be a good candidate. Let's take a quick look at our profit charts for ADSK. And it looks like the stock had quite a downturn back here in March. It started coming back here, and now it's rallied up to about 40 from a low of 30. So, I mean, it's possible that this has some potential to it. It may continue to rise higher, but there's a 200-day moving average that generally either acts as support or resistance for most stocks. As you can see, it was support when it was back here in mid-November, and now it's traded through that, and that could be resistance up here. So let's take a look at their options. And we have the 40s, and now we have a little bit better strike price differential here, because we've got 2.5 points between strikes that we can play with. Let's go ahead and delete out this monster trade here, and go to June 42.5. And we're going to go ahead and buy a double diagonal, double calendar, and we're going to change the puts. Instead of the 42.5 calls, or I'm sorry, we're going to keep the 42.5 calls, but let's change the puts to the 40 puts. And then go ahead and analyze duplicate trade here. Okay, that doesn't look too bad actually. We've got our actual live price is just below the center of this. So let's see if we can't play a little bit more with the strike prices. What if we go to the next lower, I'm sorry, yeah, we'll go to the next lower calls, which is the 40 calls, and let's go down to the next lower puts, which is the 37.5 puts. Now we're a little bit too far over to the right, so we can't seem to get this exactly in the center. Let's do this. Let's close that out, go back to our trade tab. Let's see if we can't. We're trading right at 40 now. Let's see if we can't get a calendar at least at the 40 strike price. That doesn't look too bad at all. So what we've got here is a calendar. The symbol is ADSK. We are looking at the June 40 calls. We are right-clicking on those. We are going to buy a calendar at the 40 strike price. We are analyzing it as a duplicate trade. And you know what? It doesn't look too bad. Now all you have to do is determine exactly how many contracts you want to do, and in addition, you want to take a look at your break-even points here. We want to try to get in the center as much as possible. I believe, based on the current state of the market, I think we're going to drop down a little bit in the market. This stock may follow, it may not, but our break-evens on this are these red lines here, and it looks like we've got a break-even on the left side of 38, and we've got a break-even a little bit higher than 42 on the right. And if we go back to our profit charts again for a second, 38 is down here where prior support was for this group of trading days in here, and 42, a little bit higher than 42, maybe 42 and a quarter on the upside is our break even, and that is right around where the current resistance of this 200-day moving average is. So this looks like a very, very good trade. Now all you have to determine is how many contracts you actually want to do. Let's go back to the Analyze tab. I'm just going to bump this up a little bit to 5 contracts. Our maximum profit on this is going to be approximately $400 at expiration of the June contracts. And we're going to add this to our portfolio. It looks like we've got a nice range to move in. We've got a peak profit here. Now we may have to adjust this later, which will give us an opportunity for even additional more profits, for more profits. However, at this time, you know, let's put on this, get this started at least as a trade in our portfolio, and let's start collecting some theta here. So our debit is 65 cents, as you can see, and that's the most that we can lose in this trade. When you're doing a calendar spread like this, whatever your debit is your maximum loss. So you can't lose any more than 65 cents in this trade. The margin requirement over here for this trade, even with 5 contracts, is only $325, and it gives us an opportunity to really diversify our portfolio a little bit. Let's go back to the Analyze tab, keep this on, go from single symbol to portfolio beta weighted, and see what it does to our portfolio. Let's take it off and put it on. Take it off and put it on. It doesn't move our price exactly, but it does give us a little additional profit potential in our green line up here. Let's take a look at that. From here, which is $2,197 in our demo account, to $2,484. So it gives us a little additional profit potential. It does diversify us a little bit. So we're going to go ahead and put that trade on. We're going to try at the mid price, which is currently 70 cents. It just bumped up 5 cents on us while I was talking. We want to try to pay as little as possible for our debit spreads, but I think this is a good one to put on. So we're going to go ahead and add this to our portfolio. All we have to do is hit confirm and send, and just take a look and make sure everything's right. We're selling the June 40 calls, and we're buying the July '08 calls, both at the 40 strike price on a 5x5 calendar spread. And there's our cost is $350 plus $15 in commissions, and our margin is approximately $350. We're just going to go ahead and hit that and send it. It's working, and we got filled immediately. So we are now in that trade, and it looks like we're going to be in good shape here. We're going to follow that trade along with our portfolio, of course, and analyze it as not only as part of our portfolio, but we're going to manage that trade individually if it happens to be working against us, and make adjustments as necessary. Okay, guys, that's it for today. Trade with confidence.